Guys, welcome back to the series on the fundamentals of the stock market. Today we're going to continue on the trend analysis. We're going to continue on about the support and resistance. Today is super hot in Vancouver, so before we get started, I'm going to get some bubble tea. Oh yeah, that's good. And also make sure you stick to the end because we're going to talk about a really nice resource that everyone can use that will screen certain trends for you so you don't have to go through 100 stocks yourself. Okay, so in here we talked about different type of structures for trends, uptrends, sideways trends, downtrends previously. We also talked about supports and resistance. So we're going to continue that topic and talk about what are some of the characteristics of these support and resistance. One of the first ones that I want to highlight is called the role reversal. So we talked about a support and resistance often forms in these channels. If you go back to the previous trends, these upward trends, these side trends, these downtrends, they form a channel, right? A channel means that there is going to be two trend lines, one that's touching the highs, one is touching the lows. And these form the support and resistance. So if you don't remember what that is, take a look at the previous video. And in here, when you talk about role reversal, it means that when the support and the resistance breaks, then the role actually gets inversed. So what does this really mean? Let's take a look at these two different charts. The first one is, if we see over here, right, before the line gets break, this serves as a support, meaning that the price cannot really go below it, or it's hard to go below it, right? So it bounces on the support 2 times, and then the third time it happens to break through. When it breaks through, when that happens, this trend line now becomes a resistance. When the price bounces back up, it actually touches the ceiling twice and it bounces down. So this is what it means by a reversal. The opposite is true for resistance as well. So let's say in here we see a upward trend, however the resistance is hit so that the price never breaks above it. Once it breaks above it, then this now reverses into a support trend line, meaning that it's hard for the price to break below it. So why does this occur? Why does a role reversal occur? Well, the reason is usually because when a trend line breaks, right, a new structure will be formed. Generally, you don't really see these, when a trend line, when a resistance is formed, it takes a lot of iterations for it to break. And when it breaks, the price generally goes further up or further down. And once it goes further down, it still eventually will fluctuate, right? We talk about how the price never just goes one direction, it always fluctuates up and down. When it fluctuates back, it touches the trend line again, and now people are looking at this and thinking that, okay, previously, let's take a look at the second chart, right? Previously, let's say at this level, it was not a good price to buy because everyone was selling it. Now it went further back up. When it comes down and touches this trend line, it is now a better opportunity to purchase. So this is one of those examples where, because many people are looking at these support and resistance, and many people are looking at these role reversals, they believe it will happen and they make the orders. And because the orders goes in, there's demand and then the orders supply, then that forms the price of the stock. We talked about this in the very beginning of the lecture, right? So this is a classic example of support and resistance role reversal. Next, we're gonna touch on the trend length, right? So trends can happen over a long period of time, and it can also happen over a short period of time, or it can be somewhere in between, right? And this is interesting because let's talk a little bit of history. Charles Dow is the one that developed a series of principles for understanding the trends, right? And this later became the Dow Theory. He believes that price moves in waves or trends and is much like rising tide, where the waves will move further up to the beach with each ebb and flow and cause smaller ripples. What does this really mean? This really just means that he was dividing the trends length into primary, secondary, and minor, 3 different types. Primary being the longest and minor being the short term. Generally, the primary trend length is about 1 year or longer, whereas the secondary is about 1 to 3 months, and minor is about less than 1 month. If you are a short-term trader, you probably won't care too much about the long-term trend. Whereas if you're a long-term investor, you probably don't care that much about the minor trends. However, right, if all these 3 types of trends align together, that will be the best opportunity for going into the market. So what I mean by that is, if you're a short-term trader especially, right, sure, you look more on the short-term trends. And generally short-term trends are stronger. Because it is short-term, it's more likely the same people that was there selling at the resistance are still going to be there, right? Even though you're only looking at you're most likely looking at the short-term trend as a short-term trader, you still want to look at the long-term trend. Let's say if the long-term trend is in a downward trend, and you want to buy the stocks. Even though the short-term trend might favor it, the long-term trend is an important part because this is where all the long-term investors are also looking at. If you're trading against them, it is more likely that you'll lose out. So it is important to, when you're looking at predicting or speculating, right, you want to think about how the other people, other competitors, the players are thinking, what their behavior are like. And you want to understand it so you'll trade in favor in the way that most favorable to you, right? So again, trend is a very basic technical analysis that everyone who trade should understand. And honestly, a structure is very important. When we're talking about structures, we're talking about these higher highs, lower lows, whether if it's uptrend or downtrend. These are super important. Itself probably isn't a strategy. It's very simple, right, to understand. But I'm not really a big fan of complicated strategies because the more complicated it is, the more variables a strategy has. And honestly, too many variables only increases uncertainty in trading. Sure, you probably need more than 1 variable or 2 variable, more than 1 analysis to really have a better grasp of the market. But if you have way too many, it increases your uncertainty. Let's say you can predict the whole market, but your uncertainty is 50%, so you're wrong 50% of the time. Then there's no point for this analysis, right? Okay, so I'm gonna talk about a really important part here, and this is a really cool resource that you guys can use, and this is called FinFizz, right? FinFizz is this website that actually screens certain trends for you, and in here you can actually see they already screen a few tickers, so a few stocks that are in favor of certain trends, right? We talked about trendline supports, trendline resistance. We also talked about channels. They actually screen these, and you can take a look at it, right? Let's say we take a look at this eBiz. You can see that this is a channel, and they are near the top of the trend line. So they have a lot of great screeners and resources where it can do a preliminary screening for you to analyze further with your other strategies. You probably don't have time to look at more than 10, 20 stocks a day, right? So using this can very quickly narrow it down for you, and you can play around with it. You can actually even just search for any tickers, and they will draw out some trends for you from a daily, weekly to monthly time frame, right? And I want to talk about how in trading you definitely want to look at data analysis that other people are also looking at. Why? Well, because of what we talked about at the beginning of this lecture, right? Not this lecture, but beginning of the fundamentals of the stock market series. What makes a price move? It is because of the orders that's being sent by people, by traders. That's what causes price to move. So if you want to see, if you want to understand and predict other people's behavior, then you want to also see data that other people are also looking at. If you're looking at data that nobody cares about or people don't even know about, it most likely will not affect their behavior or their psychology, and hence it will not affect the price of the stock, right? So FinFizz is one of those resources that many people take a look at. So I suggest you guys take a look as well. Again, play around, take a look at all the tickers. Since they screen it for you, it's pretty cool. You can even just go to their website and click on, let's say you want to look at a channel up, right? And they actually list out a few of these stocks. I mean, many of these I don't even know, right? So don't just trade because of these trends, but this will be a good screening process for you, so you don't have to do it yourself. Cool. I hope you enjoyed this series. It's getting super hot, so I hope you guys take care. Thank you so much, and next time we'll talk a little bit more about chart patterns. So until next time.